What essentially happens on the financial markets can be explained with three product categories. A market is a trading place for buying and selling products. The financial market is not different. It's simply the buying and selling of financial products. These products can be divided in three categories. 1. The supply and demand of capital. 2. The supply and demand of foreign currencies. And 3. The supply and demand of risk. The supply and demand of capital. The products in this category connect parties that have a need for capital with those that have a surplus of capital. Let's start with the demand for capital. A need for capital can be to pay operational liabilities such as wages, suppliers or taxes. Another source of demand is the need to repay debts or to make investments to produce goods or render services. Also, consumers borrow to buy houses, other consumer products, or to bridge a period in which they don't have an adequate income. For example, to allow them to focus on their studies. But not only corporations and consumers are on the demand side of capital. Most governments also run large budget deficits that need to be financed. Now, who is supplying this capital for these parties and why? Capital is supplied by parties that do not need their capital for a period of time for future payment, direct investment or consumption needs. Most corporations and consumers supply capital by accumulating savings, while the main capital suppliers are in fact institutional investors, pension funds and insurance companies. Supply and demand meet each other's needs either via direct transactions on the financial markets or indirectly by using financial intermediaries, such as banks. There are two product types available to connect supply and demand for capital: shares and loans. First, we talk about the shares. A company can issue shares to raise capital for its investment plans. The buyers of the shares then become part owners of the corporations. The reason to buy the shares is that capital suppliers or investors expect the corporations to be successful and to benefit from the generated future profits from its investment plans. Profits can be paid to the owner as dividend or accrue via capital growth in the corporation's share price. As a result, the investor can then sell the shares for a higher price to realize increase in accrued value. However, if the corporation does not meet the market's expectations and is unsuccessful, the shares will drop in value. Since there is no right of repayment to the share buyer and future profits depend on many factors, the buying of shares can be a risky proposition. Because of this risk, investors expect a higher return if they buy shares than if they deposit funds into a savings account. Now let's summarize. The expectation about the corporation's future financial performance is key in attracting investors to supply capital by buying shares, and it determines the issue price of new shares. Most of the trading of issued shares happens at exchanges to make it possible to buy and sell quickly. These exchanges publish price indicators that also can be used as a performance benchmark or for derivative products. For example, the well-known Dow Jones Index is published by the New York Stock Exchange. This graph of the Dow shows that share prices can be very volatile. It shows the Dow Jones Index from the year 2000 till January 2014 and indicates the volatility underlying the share price changes. The Dow ranges from approximately 7,000 to 15,500. This also shows the risk of buying shares. Share market prices and indices will go down if economies are facing problems. As soon as the economic outlook improves, investors will start buying shares in the expectation of increasing profits and returns. So shares are high-risk financial products that connect capital demand and supply. The other product type for demand and supply of capital is loans. A loan is also a deposit for the capital supplier, the lender. The main difference to shares is that in the case of borrowing and lending, there are loan agreements entered, which set out the maturity of the loan, the interest rate, and the payment arrangements for interest and principal reductions. These agreements make loans a less risky investment for the supplier of capital compared to shares, and thus it's easier and generally cheaper to raise capital by borrowing compared to issuing shares. Loans can also be tradable, for example as bonds and commercial paper. Commercial paper has a maturity of maximum 2 years. Bonds are long-term tradable loans. Because of the substantial issue expenses, tradable loans are only issued by big corporations, large financial institutions, and governments. Most governments run high deficits that are funded by issuing tradable loans, such as Treasury bonds, notes, and bills. Interest, or yield, is the agreed compensation for the lender for capital supply and risks. A main factor influencing the interest rate is default or credit risk. That is the risk of interest or principal payments cannot be paid. The higher the default risk, the higher the interest rate charged to the borrower. If a loan is not tradable, the credit risk for the lender is higher as the loan will prove to be a less liquid form of investment. If the default risk of a borrower is too high, it may not be possible for the borrower to cover its debt capital needs. To assess credit risk is a complex task that requires data mining, analysis, and expertise. Commercial rating agencies assess the default risk for the issuer of the securities by publishing ratings. Well-known rating agencies are Moody's, Standard & Poor's, and Fitch. Investors rely on these ratings for their lending decisions and interest compensation. Besides credit risk, other factors that can impact the interest rate level include maturity, inflation outlook, economic situation, politics, and central bank policy. This graph is an overview of the 3-month euro deposit rate. This interest rate is set on the money market, the market for short-term demand and supply of capital. Although central banks use monetary policy to steer short-term interest rates, it is far from stable. It has varied in a range of approximately 12% in 1993 to practically 0 in 2014. Now let's have a look at recent long-term interest rates history. In this graph, the blue line is the yield for 10-year government bonds from 2000 until 2010. The yield range is between approximately 3.8% and 7%. The green line shows the interest rate for government loans with a maturity of only 2 years. The grey line expresses the difference, or spread, between 2 and 10 years Treasury loans interest. This graph shows that also interest levels for long maturities are volatile and unpredictable. The graph also shows that long-term interest rates are generally higher compared to short-term interest rates. This is typical for normal market circumstances.